through training with Amplify and having traded equities in the past on my own book, and then going into a prop firm, quite a high level prop firm, and everything that was kind of encompassed in that experience. And then really what to expect, what you would learn, what is expected of you, and everything in between. So without further ado, let's just get into this session. To give you a little bit of background, I've been trading equities for about 12 years, mainly kind of buy and hold investment positions. So my best trade to date has been buying Apple at 42, quite a number of years ago, way before the split. That was nice, got into that. Amazon, a couple of oil companies, and I was doing that while I was also running my own technology company. Companies, I'd started and sold 2 companies within that time and folded another one. But all the time trading equities, not really going in for a kind of a pension saving sort of an idea, more actively trading what would be my pension fund. Then went from there, made quite a bit of money on the exit on one company in particular, and decided I was out of technology and going full-time as a trader, and was not so enamored with getting involved in the day-to-day noise on equities, as I'd had the luxury of seeing how equities trade, and you can have huge swings within a day and a week, and just huge volatility that I didn't really want to get involved in, essentially what I would become to know as scalping. But I did have an interest in the oil industry, given I have sort of a small family background in the oil industry and kind of understand that space a bit, and understood futures and hedging a bit better. So I really wanted to accelerate my learning in that and change career into trading. So I trained with Amplify January 2nd, 2017, and with a view to further managing my pension fund actively, and then went on to trade my own book, and this is all on a blog on Amplify. And then after about 3 months, I have been doing great, and then really got caught out on an OPEC. I think it was an OPEC cut. It was an OPEC cut, in that all the way leading up to the Vienna meeting, it was in sort of April, May. The market had been expecting this cut, and the market had been rising, and I had certainly been getting long and enjoying that rise on an intraday trading level. And then when the cut's actually confirmed, I was still trying to get long into the market, which was actually just reversing, and it was buy the rumor, sell the fact scenario. And so I lost about a third of my capital on that, and just said to myself, right, you obviously are not fully geared up to trade the way you want to, and so you really should step into the highest professional level of trading that you can at this point. And so therefore I applied to Susquehanna, which is one of the largest prop trading firms in the world, very algo focused. I'm not a great computer programmer, and didn't really want to be an algo trader. I applied, did not get that firm. I applied to a couple of others and got offers from 3, but from that experience I learned that there are different types of firms set up in different types of ways for people to work with them. So that brings us on to the first slide, really, in that you can have arcades, which are essentially pay to play. So an arcade is, they would appear as a prop trading firm, but then they would say, well, you have to put your own capital down, and we will give you depending on how much capital you put down, they'll give you anywhere from a 30 to an 80% split on your winnings, if you like, from your trades. And you would also have to pay desk fees month to month. Now that's not an attractive position to be in, because essentially the firm doesn't have really any skin in the game, and you have all your skin in the game in terms of your trading capital. It's not really the best place to go into unless you have extremely strong edge and you are extremely profitable on that edge. So you're consistent, week in, week out with your trades. You're not overactive, and essentially otherwise you're just going to bleed all that money into the firm and into the markets. You're going to get bled to death on desk fees, on software fees, and you're only going to be getting 70% of your winnings, and your costs per contract to the exchanges or to the brokers is just going to be far too big. So what I liked about Geneva at the time was that they were a very large firm, founded in Ireland. Then they, in the 90s, they went on to open an office in Chicago, and then went on to really be one of the top 5 firms trading prop in the world. So I was asked to go in. I'd done a rudimentary phone interview, and then went in and met the head of trading, and I'll describe a little bit of that process first, but I want to finish off on this slide before that. So professional firm versus arcade. You really want to be with a firm that is dedicated to the development of you as a trader and committing capital to you as a trader. At that point, when you're having that conversation and trying to figure this out, you'll know if they want to work with you as a trader or not, when they will say to you, well, we want you to put in X amount of money or not. If they want you to put in money, that's an arcade, and they're not so much interested in making money with you, they're more interested in making money out of you. Then you look at firms as well. Do they pay a wage? Do they not pay a wage? Most firms do not pay a wage. Geneva Trading is quite unique in that sense. Susquehanna is unique in that sense as well. They would pay you a wage, which is kind of a guaranteed floor of earnings, to kind of let you survive through a win, lose, or draw month, for example. So it's very, very hard to find a firm that does pay you a wage. Most of the other firms that are real will not pay you a wage, but they will let you do an induction program of 3 months, and at that point, you'll be trading on a sim, for example, for maybe if they've already seen your trading blotter or your trading fills, they would say, okay, we'll put you on like 2 weeks sim or a month sim, but there'll be no wage during that time, and then thereafter they would have you on 50% of your trades, or depending on how strong your edge is, maybe 60 to 70%, but you can't really ever come out of the blocks on 80% unless you're like a strong hitting trader moving from one firm to another, for example. You also want to look at the style of the firm, and you can kind of find this out from kind of hunting around on some of the forums like Trade to Win or EliteTrader.com. These are pretty interesting spaces. So just for Peter, can everyone else hear me still? Just if we could get a Y to confirm that. Okay, great. So you can still hear me. So where was I? Yeah, really what you want to do is you need to identify how you trade. In Amplify, a lot of the focus is on position trading, getting long, pivot, classic long, getting short, R1, classic short, and holding that trade to a predetermined destination. You might get a short R1, trading it down to the lows of 2 days ago, because you've technically analyzed there's a lot of free fall there. You have some elements lining up, and the market is irrelevant really. That's position trading. Then you'd have hedged, unhedged positions. So if you're sort of doing what I call high velocity, high volume scalping, which is certainly what they do in Geneva Trading, amongst other styles. You might get into a position where you would be 200 clips long oil, and you might hedge that with 50 clips short gasoline, because they're so tightly correlated. You would be hedging off your position long, and you would use very simple mathematics to tell you how much hedging you need per one contract of oil, right? So these are things that you would actually either learn on your own, or it would certainly be drilled into you and you would learn in an induction period in a trading firm. So you do some pretty simple maths. It's really, it's really not that difficult. You're not looking at crazy mathematics to do any of this stuff. Other styles are intraday is sort of position trading. Anything really falls within intraday trading. Scalping, you just get long 55 handle on oil because it's been holding a support. You're on a third test and the sellers are giving up, and you just get in, hit it with whatever amount of contracts you have, and then you scalp out. Could be 5 ticks, 10 ticks, could be 20 ticks. That's more scalping. Anything above 20 tick profit on a contract really is, to me, it's position trading. Scalping, when you're scalping, you don't really know how much the contract can go in your favor. Sometimes you might get into a scalp opportunity where you just know we're coming up to a big handle, you have at market to sell on that handle, and your stop is below the blow past level above, and then you just scalp into it, and then you have automatic bracket orders that take you out 10 ticks reversed off the level, and that could happen in seconds, and that's a scalp. It's not a position trade, and that's sort of scalping. And that's something that you would learn in a prop firm, to hit things with very big size. Then the other style is mean reversion. That's really something that a lot of bond traders do. The most simple way to look at that is using a Bollinger Band method, for example. You would also use something called the Z-score, which tells you how something is really out of, what we call it, out of whack in prop land, but you would say something is so far out of correlation that it just needs to now revert to the mean. So you would wait until something has like a minus Z-score of 3, which would say you are really pushed way outside the bottom of a Bollinger Band, and it's now time to get long and trade it back into the middle of average pricing. And so that's something that bond traders do quite a lot. Then there's other guys in prop firms who would be in the larger sized sort of upper echelons, who would never be out of a position. So that's something kind of to get your head around, which can be a little bit scary to people. But no matter what oil, for example, does, I know a friend of mine, Sid, he's probably the largest oil trader in Geneva trading, and he's never out of a position. He's always either buying into or selling out of hedges. So he'd be like long oil, short gasoline, and maybe bring something else in there, like a bit of S&P, to smooth out the P&L curve, and really hedge himself out. And he would just work in and out of position across the 3 products all of the time. That's all he would do. So that is a very sophisticated strategy, and you need a lot of bank to trade like that. Sid would have, I don't want to be talking outside of school, but you're talking about multi-millions to be trading that level. But that's the benefit of trading with a prop firm, is that if you find something, they will back you on those trades. So that kind of brings us on now to the next slide, which is it'll bring us on to the next slide. But this is really the entry requirements slide to get into a prop firm. So primarily, these are the things that you need to get into a firm. You really have to show edge. At the time, I was working a strategy that was based on a MACD histogram with a little bit of stochastics, and I developed some edge in that, and I was working that quite well, along with a little bit of position trading and a lot of what I'd learned in Amplify. But you just have to show that there is reasoning behind most or all of your positions that you take. You can't just be like, well, it was going up, so I thought I'd buy it. I mean, that's just not good enough for any trading manager or risk manager to say, all right, cool, we'll give you like £1 million on next month's book. It just doesn't work like that. You have to be like, well, there was XYZ happening, and then we had a fundamental catalyst top in, so everything lined up with this trade. I took it, and that's all I did for the week. Maybe I did 2 trades for the week. Now, to a lot of people, you guys might be doing 5 trades a day. You might be doing 20 trades a day. But professional traders, and I say this time and time again, professional traders are like snipers that sit in the bushes, and they just wait for their target to step out every now and then they just take a shot, and that's it. I mean, I'm sure Sam would agree with me. I mean, you can't really be in every move, on every trade, on every rotation of the market. You really just have to wait until everything lines up and you just see that you have to take this trade, and it's just better looking than everything else that you've seen over the last day or hour or 2 hours. So, and that's something I work on with. I have several mentees that I work on edge with, both psychological and risk edge. Or really, I work with them on a psychological and risk framework, and then we put edge on top of that. So that's something that's working very well for some of the people that are in the room right now, actually. So coming back to the entry requirements, resilience. Trading is not easy, okay? And if you're gonna, kind of walk after 3 months, after 6 months, or you're positioning yourself to only give yourself 3 months or 6 months, well, you're not really showing resilience to dedicate yourself to a craft. There are literally rocket scientists. There are literally the smartest minds that have ever been, like Professor Black and Scholes. They won a Nobel Peace Prize for mathematics, and they had a trading firm called Long Term Capital Management, and they almost brought down the US economy with their trading algorithm. The smartest minds fail at this. Degree in economics, I don't care. You're a rocket scientist, former SpaceX whiz kid, I don't care. What's more important is the market doesn't care. You need to show resilience and fortitude of your psychological well-being, essentially, to trade. And you have to always be learning. So in prop firms, they want you to be aware of and honest about how you make money and how you lose money, and be honest about your downfalls. Essentially, if you go into an interview and you try and blag it or bullshit with a head of trading, he's going to know it and you're going to be out of there. If you're really honest about, well, I sold this, it was a complete donkey of a trade, I puked it when it got 1.5 times my risk for the day, he'd be like, okay, fine, that happens. You got to realize that the people interviewing you in prop firms have seen some of the most monumentally terrible trades that have ever been, and there's lots of stories I could tell you about trades that I've seen that were terrible, that came from really good traders who have pulled down. I've seen some of those guys pull down $250,000 in 15 minutes, and then I hear stories about, well, they took a hit on this for like 5 million, and things like that. But you have to be honest about where you are as a trader and where you want to be as a trader, and then the firms will lean into that in an interview process. So I would recommend you track all of your trades in a blotter using EdgeWonk, or just download them and put them on a spreadsheet, or use TraderView, something like that, and you can start to develop an equity curve and a performance curve for yourself. And if you can show certain developments on that curve, well, then you're going to have something to go and show a risk manager or a head of trading who's doing interviewing for a prop firm. Another thing that, the test, there are tests that you would do. These would be very simple tests. If you're not going for an algo trader job, the test would be very simple. Like if you buy 2 contracts of oil at 57.10 and then you sell them at 57.11, what is your P&L position? So basically you just got to account for the in and out cost of 4 contracts because you were too long then too flat, then you have to add up your P&L position for that, and just very simple stuff. But then they'll go into coin flip tests about some statistics around coin flips. If you take a coin flip 50 times or 100 times, what's the percentage probability that it will come up heads? And I think the answer to that is 67% over 100 flips. But I didn't get that right. But what I did do in the interview was I took a guess and I said, you know what, that's a total wildcard guess, and I was honest about what I knew and what I didn't know, and that's something that trading managers can respect, because there's nothing worse than being in a risk management situation and somebody is lying to themselves, let alone not being truthful or being able to be have a clarity of vision about where they are. Right? You need to just be able to say, I don't know, and that's okay. So a lot of the tests for prop firms can be like that when they're looking to back you with money. They just really want to know, are you going to be straight up about how you think and where your thinking is at any given moment. So another thing is managing risk. Can you manage risk day to day, week to week, month to month? For me, I was able to go to a prop firm with about 3 months or 4 months of futures trading experience, and then I didn't really get involved too much in my equity trading experience because they were very much a futures shop. But I certainly did show them a little bit of performance on my equities, and so they knew I understood markets, exchanges, and how that works. Okay, so here's the big shocker for most people do not understand about any of this. So in a prop firm, there are desk fees, there are software fees, exchange data fees, and round trip fees. Now, desk fees. So in a very sophisticated firm, you're going to have desk fees, and these can run to several thousand euros or dollars a month. So what is that covering? That's covering your technology, your computer system, the speed of that system. You're probably paying for a last resort power backup system that's in the basement of that building, and everything that goes with that. So you could have for example, in Dublin, we could have a total power outage in the country, but the firm that building would still stay lit. Our computers had backup power systems at the desk. The internet systems had triple failure redundancy, meaning that we could have 3 points of failure on 3 different backup systems, and we would still have a connection to the exchange in Chicago. We had the fastest available internet speed in the country, with a hardline connection to the exchange, which went on a hard line across the ocean into New York. So we had the best of the best, and so therefore our desk fees were very high. You're talking about mid to high. You're talking about upwards of 5,000 a month, just to be able to sit at that desk and have everything that's plugged into it work for you. Then you have software fees, so they would be nominal. So you're talking, less than maybe 1,000 a month for proprietary software that would be developed inside the firm that no one else on the planet has access to apart from traders in the firm. You would also have a dedicated software team that would be backing up that software and fixing any bugs ad hoc all of the time. So we had 3 or 4 people in Dublin, another 10 I think in Chicago, and we could access those people at any times to fix any bugs on any of the proprietary software we had. I can't really talk about any of that software at the moment, but I will tell you that what we were being charged per month for it was worth it, definitely worth it, and gave us a lot of edge as traders. And so some of the software that I use now is very similar to that software. And this is something that you just do not get exposure to if you're just trading on your own. But can you trade successfully without this software? Yes, you can. But I think in order for you to do it, it's kind of like, well, you should know what's out there to then be able to trade without some of what's there, and you just kind of points you towards what you should be looking at, really. Then you got exchange data fees. So that's, for every exchange, I think it's like $90 a month to connect one IP address, i.e. one computer, to NYMEX. On NYMEX, you've got all your energy constituents like gas, oil. Then you want to trade Brent as well, so you connect the ICE, Intercontinental Exchange, which is based out of London. That's another $60, I think, or $90. And there are other markets on ICE as well. And then maybe you want to trade DAX and Euro stocks, so you've got to connect to the Eurex exchange, which is another $120. And then maybe you want to trade some corn and cotton, so you connect to Kansas City exchange as well. And then you might want to trade some Bitcoin, so then you connect to Bitfinex or any of the multiple crypto exchanges that are out there. And you as a trader, this all goes into your monthly charges. That's a bill that comes from the prop firm to you as a trader. Now, you could easily rack up quite 15 grand's worth of fees in a month and lose 10 grand into the market that month too. So now all of a sudden you're at negative 24 grand and you're thinking, what the hell am I doing? But the upswing is that you are able to leverage the finances and the structure of the firm to your benefit. So while you might be taking a bad month, you still make your wage, and they roll the fees on to the next month, and they won't let you really go 3 months without really stepping in. To be honest, they won't really let you go for a month and a half without stepping in and really finding out what's going wrong with your trading. Why are you deviating from the edge that you had when you started trading with them? And they'll get you back on track. But the main benefit is you could go from trading 5 to 10, even 20 contracts on oil outright, and then go into a prop firm and say, right, here's my edge, I'm really consistent on this, I want to work with you guys. And they'd say, okay, fine, we like what we see from your performance results, so we're going to give you 500 contracts long oil outright. Now, maybe they wouldn't like the outright bit so much, they might want you to hedge off some of that risk on every trade, but you're certainly now trading a $5 million book, or a $10 million book, on just your risk. And I mean, obviously you have daily risk limits, which are agreed with a risk manager as well. That risk manager sits about 20 feet away from all of the traders on a trading floor during a given day, and you can certainly talk with them face to face if you need a little bit more risk on a trade, which would not be uncommon. You would IM chat the risk manager, or you might just go over and say, listen man, I want you to give me a bit more on this trade. And you say, okay, well, what's your plan? And you say, well, I want like half a risk unit more, and at that point feel free to cut me out. And so if the trade comes a half a risk unit back in your face more, he'll just cut you out of the trade, and you just gotta take it on the chin and look forward to trading the next day. So these round trip fees are a bit of a just part of doing business. It's a cost of doing business. So for one contract in oil, for example, you might pay, depending on your broker, I think RJ O'Brien charge £4 for a contract in and 4 out. I pay a lot less than that with my broker. If you're in a prop firm, you would pay a really low amount for that, given that your broker is probably Goldman Sachs for the firm, and so they have very good agreements with all of the different exchanges around the world, and so therefore you're paying a way lower fee, round trip fee. 1 in 1 out, that's a round trip or an RT. And this is just part of the language that you would talk to a broker with. All right, so moving on. Edge. Okay, so once you are in a prop firm, or even if you're not in a prop firm and you're thinking about working for yourself or trading for yourself, everyone talks about edge. Now, what the hell is edge? Well, there's lots of different ways of describing edge, but essentially it's your ability to see the market a certain way and trade the market a certain way, and that's what you do, and that's just your unique way of trading the market. This is something I work a lot with my mentees on, to accelerate edge, to build strength within their edge and psychological commitment to what their edge is versus what their edge is not. And that's very important. And if you don't know what your edge is, it's similar to shooting bullets into the dark, because you might be getting some lucky breaks buying support and resistance, but then you're at risk if you're not fully cognizant of how you're trading your edge day to day, trade to trade. You are at risk of sort of a lot of psychological risk creeping into your trading. You have a great day one day, I guarantee you 70% probability the next day you're going to come in, you're going to do your ass for 70% of what you made the prior day, or maybe all of what you made the prior day. Why? It's because you had a good day, you were probably using an edge that you were unaware of, and then the following day you came in and you did a trade which did not adhere to your edge, and you did your ass. And then you go, what the hell, why can't I get ahead in this market? I win one, I lose one, I win one, I lose one, or I win one and I lose two. And then you get into a spiral and then you think, oh man, I can't trade. Well, the reason is because you're not dedicated to perfecting your edge, and you're not committed to strength in your psychological commitment to that edge, in my experience anyway. So within a prop firm, they will definitely look to just have you stick to trading your edge, and if you deviate outside of that, they will get really worried, and there'll be multiple meetings until you get back on track. If you go outside of your edge for 2 days and trade in a very different way for 2 days, they will be on top of you. Your risk manager or your head of trading more likely will be on top of you saying, what the hell is going on? Why are you trading like this? And once you're on track, they want to accelerate that. And how do they accelerate that? Well, they upsize you. So you would go from, as I said, like the 10 contracts up to, you could find yourself trading 1,000 contracts, especially on something that's less volatile, like a 2-year, 10-year spread, or hedged 2-year, 10-year US Treasuries. Like if you're trading a 2-year, that thing does not really move that much. So why you want 1,000 contracts? Because for you to make money within that market, you either trade large size or you trade for big moves. So prop firms have no real problem sizing you up once they know you have edge and that you're consistent with that edge. And it can be pretty scary sometimes. I remember the first time myself and the guys who I was with were scaled up to 1,000 contracts on oil, for example, or like the US 5-year, I think it was, or US 2-year. We were just thinking, holy shit, this is like this is like the big leagues. What the hell are we doing, getting into very large positions? But we stuck to our edge, we stuck to our strategy, and it worked out. And some of the guys were able to take very big swings in the market, like very big position trades in the market, by just averaging in with that type of size. And then once the market averages back up and releases back to average pricing, well, you can suddenly you're very long a market that is now swinging back to average pricing, and you can really capitalize a lot of money. You can bag a lot of money on a very small move in those situations. All right. There's other things like really the studies that you would do when you join a prop firm, you would very much be like looking at, for example, how much does the S&P move on non-farm payrolls within 1 second, 5 seconds, 60 seconds, 5 minutes, 15 minutes, and an hour after S&P data release on the dot. And you would chart those movements for example, we charted across almost every or tier 1 and 2 data releases. There's tier 1, tier 2, tier 3. So tier 1 and 2 being more market moving than tier 3, right? So we would chart out exactly how the markets moved within those time periods from the data release. And we would then develop a probability picture against beats, misses, or inlines of that data. So if we had non-farm payrolls more or less in line with expectations, we would have a book, a spreadsheet of data beside us showing us that, okay, inline movement, average, swing, up or down on this is 10 points, for example, or New York was Empire State Manufacturing. We have a beat that's a significant beat. We would be like, okay, this is average going to move us 20 ticks on the upside within 30 seconds, but then we're looking at a reversion back to our starting price within 5 minutes, right? And so you're starting to really dig into and analyze these data movements, or how the data moves the markets. All right, so moving on to lifestyle. I mean, being part of a prop firm, until you're really showing a consistent edge, if you're going through the training program, they're going to have you trading most major markets every day on the opens and closes and high volume periods. So I remember I was trading, I think I'd start the morning with the DAX, then I'd move on to I think it was Euro stocks, SMI index, and we trade these opens, and then we go on to let's see, we'd have sugar, cocoa, coffee, then we'd have live cattle, feeder cattle, then we'd have oil, then we'd have S&P, NASDAQ, Dow, all US cash equities, and then we would move on to you would swiftly just do a trade on the opens or the pre-opens and then be out of that trade and moving on to the next. Or you might be trading across multiple different products on those cash opens and playing hedge strategies. For example, you might get long NASDAQ, short S&P, and then you might flip that position and to be long S&P, short NASDAQ, or you might be spread across 3 different expiry dates. For example, you might be doing long, what you'd have quarter expiries on. Well, say on oil, for example, you have the oil open, you might have a fly spread strategy. So you might be long the January contract, or say at this moment in time, you might be long December contract, short January contract, and long February contract. Okay, so you would have a hedged fly position long on oil for that open, for example. You might want to hold that for the day. But to keep it simple, just getting long or short the individual contracts. After the US cash open, we'd really have this lull of hours between the opens and then the closes. You were either managing positions that you wanted to hold from those cash open times, so really from 2 p.m. onwards, and then you would go off to the gym, you go to the cinema, you go on a date, you could do whatever. The trading managers really didn't mind what the hell you did, just as long as you came back and traded the closes. So you would come in and you would trade oil close 7:30, you would trade cash equity closes 9:30. I can't remember what the cattle close was. I don't actually have it up here. No, I don't have it there. But so we would trade these high volume periods, and we would be the guys coming in slamming the book on the close. Within, we could be sitting there, and with 15 minutes to go to the close, we could see weak buyers coming on the book, for example, on S&P, well, we wouldn't really play around the S&P too much, but certainly with cattle, for example, if something was kind of near the lows of day, we would certainly come in and we start slamming the bids. So anyone trying to buy that market, we would just slam it down with large size and bully the market around a bit. Or there are certain strategies we would also employ, which I can't really get into here. But that's something, again, I talk about with my mentees. It's certainly interesting stuff and certainly stuff that you really need to be aware of if you're going to be trading these markets, to try and consistently bring money out of them. So it's like really a team of individuals. So within the trading floor in Geneva, there was about 30 traders. Only traders were allowed on the floor, and it was kind of like a boys and girls club. Although we only had one girl on the team at the time, who was trading ags, so that would have been corn, and corn and soybeans, soy oil, all these sorts of stuff. But it's really like a bit of a club whereby you just trade your own business on the floor, and you can talk to other experienced traders. You can kind of mentor off with other traders, and you're sitting there beside you might be trading a book where you're only like maybe 100 contracts on oil, and you might be sitting beside a guy who's got like 5,000 contracts on oil, that sort of stuff. Or you might be sitting beside one of the largest bond traders in the firm, and you're just starting out and you want to focus on bonds as a trader. But the most profitable guys in firms, from my experience, are guys that do specialize in just one or two markets. Guys who spread across multiple different markets all the time do eventually kind of run out of steam, because they're just monitoring so much stuff all the time across all these markets that it's really exhausting. So running your own business within a business. So eventually, after a part of time in a real prop firm, you would no longer be an employee. You would be running essentially your own limited company within their company. So you kind of think of it like you have your own company, but you have a financier, which is your trading firm, and they give you capital to operate your business essentially. And your business is your futures trading firm. It's just you on your own. But if you wanted to bring in say researchers or coders, that would just be part of your business, and your trading firm may look after all the hiring and firing of that, for example, and they just support you in everything to do with your business. So that would be managing your billing, managing your negotiations and whatnot with external software providers, but they really give all your resources to you and your business. And they do, on the training side, there's a hell of a lot of training on offer, in-house. I know one of the guys I was trading with was specialized in bonds, and he had been essentially on a bond trading team with one of these guys who was never out of a position on bonds, and he was therefore managing this guy's overnight risk. So all he had to do was monitor the position, and essentially if things got out of whack a bit too much and the risk became out of perimeters, then my friend would essentially remodel the risk and work in and out of the overall position until the risk was a bit more suitable. So there's a lot of that stuff going on, and my friend had gone to Chicago and trained with that bond team in order to do that. So there is a lot of opportunity within the firms. So really that's all I've got to say about that. I'm happy to answer any questions you might have. Peter is asking which firm was that. That was Geneva Trading. You can look them up online. Offices in Chicago, Dublin, and I think Singapore. What else do we have? Where did you find the list of firms? Well, Google is a great place. You got to get out there and look at really research. I mean, go on elitetraders.com and that's a really good website to look at. Trade to Win is quite interesting as well, and you see a lot of the prop firms are on there, and they might have representatives. I know a lot of the heads of trading from a lot of the firms, all the big firms are on there, and they're scanning across the forums, seeing if anyone's talking about something interesting. And God, what I've been on here, is that the euro that's just really had such a pasting? God, it is, yeah. Wow. Well, that is a short for holding. All right, so that's all I got. If you have any questions, feel free to send me an email or Skype me. I'm always pretty much on my computer, available to chat most of the time during the trading day. And for the stage 1 guys, really trade less would be my advice. But don't be scared to take trades. That's another thing. And stage 3 guys, same thing. Don't be overactive. And if you think something's over, like something I see a lot is people, the market starts pumping upwards and people just go, okay, I'm going to buy it now, and then the market probably needs a breather to pull back, and that's just going to take out your stop, when really you should be getting entered where your stop is on that pullback to get long, as opposed to just buying a market that's going up. There's nothing wrong with buying a market that's up if you have good reasoning to, but maybe if something's already had a good bid, for example, or a good offer down, maybe just let it take a breather and then you take your trade. So Peter, didn't you say that you're encouraged to take a sniper's approach with a few trades a day? Okay, you got me there. So I am encouraging everyone to take sniper's approach, because if you're working with your own capital or building edge, you need to apply that edge and understand you're applying that on every trade. When you're trading prop and you're trading 14 markets at a time, you are applying edge, and you got to understand that if you're trading, that is the highest level of professional trading that we were doing, is trading 14 markets at a time every day, and you need to understand that we would have a meeting at like 6 a.m. and discuss some of the things that we're going to be looking at. Like, we would all be present in office at 6 a.m., 6:30 in the morning, having coffee, talking about what we're looking at for the day on each of these markets. Then we might, take a break, trade those markets, and then have a lull kind of between 10:30 and like 12, and then we'll have another meeting about what we're looking at for the cash open. Like, we were very, very, very active, and we could afford to be trading 14 markets because we were very precise about what we were doing in those markets. But if you're 3 months or 6 months in as a trader, you really need to take your time, and you really need to develop your consistency. Okay, so thank you, Alex. Good stuff. Any more questions before I knock it off here? I think we've done like about almost hour and 20 minutes, or sorry, no, we've done about 50 minutes so far. I think Sam is almost about to fall asleep here. Any other questions? Oh no, Sam's gone. Anyone else? No. All right, folks. Well, listen. For anyone who's interested in working with me, feel free to reach out on any of the details on the right hand side of the screen right now. And look forward to seeing you all in the chat room over the coming days and weeks. I'm gonna be on quite often, and as you know, I'm just trading oil at the moment, and I think it's quite an exciting time, so I might jump on tomorrow with some analysis, if not next week. Alright, thanks everyone, have a good day, and we'll see you then. Cheers.